Londra stüdyomuzda Christian Wietoska ile birlikteyiz. Kendisi Deutsche Bank'ın Doğu Avrupa, Orta Doğu ve Afrika Araştırma Direktörü. Hi Christian, welcome to our show.
Thank you very much for having me.
Actually, this week was an important week because, you know, the economy minister was in London and he had several meetings with several investors. What are your reflections on Şimşek's visit in London?
I wasn't personally at any of the meetings this week, but we have had various conversations, obviously, with policymakers over the last few weeks and months. And I think what is very clear is there's a very strong agreement on the economic path and on the development of Turkey right now among different departments, whether it's the finance ministry, it's the central bank. There's a very strong message that they bring across that there is unity among what needs to be done to keep this kind of, I would say, success story on the economic development over the last 12, 24 months. Mm-hmm. And we have had various also important developments over the last few weeks, which are key and will shape the outlook for Turkey over the next 12 months or 24 months. On the one hand side, we had the minimum wage increase, which came in at 30%. Some initially thought it could be higher, 35 or 40. The market took this as a positive signal. At the same time, the central bank then started the easing cycle by delivering a 250 basis point cut. So this was seen also as a positive sign that the disinflation is on track, and now the central bank can start with gradual easing. And so far, all the developments also on the economic or macro side or on this stability side has also been quite successful. The net reserves have increased. We had some outflows in December, but the net FX reserves are back to 40 billion, which is very high. Gross reserves at 160 billion. FX euro protected deposits continue to come down now at 30 billion. So the rebalancing that the current finance minister Şimşek has initiated is very successful and continues. And it seems like, absence an external shock, of course, we're seeing that this can be achieved with a soft landing, with a slowdown in activity, which is needed for the rebalancing, but without a massive shock that we're going to see a significant slowdown in domestic growth.
Yeah, you don't expect a hard landing, but you expect a soft landing.
Yes, our assessment is that we're going to see still weakening in domestic demand over the next few months due to still very tight financial conditions. But these tight financial conditions are needed at this point in time to continue on the disinflation process. And we expect over the course of the second quarter to have a turnaround and domestic demand to again pick up. And growth will be probably around 3% this year. And if everything is aligned, we're going to see this disinflation to continue in the second half of the year. There is then potential for a pickup in growth in the second for 2026, absent again an external shock, some unexpected developments, obviously coming from the US or Europe.
Yeah, in terms of inflation, I think you have revised your inflation target expectation for this year.
Yeah, so we have revised it slightly higher for the end of the year. So inflation initially surprised to the downside, the headline figure for December, which was very positive. But the underlying picture still shows a bit of stickiness. And we also have made slight revisions to our oil forecast, which is very important for Turkey. We initially expected our house call was 62 or 63 by the end of the year, and now we think it's closer to 70. And if
oil price.
For oil price. So and if we now look at the developments of oil, this is one of the biggest challenge, I would say, for Turkey as well.
Oil prices.
The oil price. If we are currently at 80, right, so levels are much higher due to sanctions on Russia, which have been initiated, and these kind of things have led to a higher oil price. That is a risk, obviously, for the disinflation process in the second in Turkey. At the moment, we are not too worried, but if this continues and well above 70, we could see inflation staying higher for longer. Our current forecast still sees a decline to below 30 by the end of the year, 28%. We know the official forecast, the guidance is 21%, but with a range up to 26. So we are not that far off, and I think the current guidance from the central bank as well is very credible that we can reach level around 25 to 26%.
So did I get it correct? You have revised your inflation expectation for 2025 upward
Yes.
because of this oil prices increase.
The underlying stickiness a bit in the data in Turkey point to in the second half of the year to some upside risk to inflation on the one hand side, and the second has also to do with the fact that we revised our oil forecast.
So do you expect the rate cuts continue next week?
Yes.
The same amount, the same pace?
Yes. I think by changing the calendar from 12 to 8 meetings, we are currently in the camp. We believe that at least for the next 3-4 meetings, the CBT will continue to cut rates by 250 basis points. Inflation justifies, or the disinflation path justifies continuation of the pace of monetary policy easing. We would argue that in the second half of the year, then we could see a slowdown to 150 basis points of easing, but potentially at every meeting this year, monetary policy easing to reach rates slightly above 30% by the end of the year, so between 30 and 32.5%.
Any other updates about your expectations? For example, how many points of rate cut do you expect for this year?
So we have seen the first 250 basis points cut in December. We now see room for rates to get close. We initially thought 30%, but 32.5% is currently our base case scenario. But I see room if the external backdrop doesn't see any major surprises, whether it comes from aggressive tariffs from Trump, whether the oil price is well above 70. I think there is still room to see rates at 30% by the end of the year. So between 30 and 32.5% is probably very, very credible to assume.
So you were expecting 20 points rate cuts, but now it's a little bit less than 20
It's slightly
points.
less, but it doesn't mean that the terminal rate, and I think that's the important thing, is higher. We would then assume that the easing cycle would continue, just delayed in 2026. So we still have our forecast that inflation by the end of 2026 will reach levels around 20%. So, and that will justify additional easing, but a bit backloaded into 2026 with potential rate cuts also towards 20%.
Christian, I know that you're following Turkey also, the situation in Turkey very well, very closely. So I would like to ask your point of view about this inflation narrative. How is it going? And do you expect any pressure on the currency?
So on the latter, on the currency, obviously, Turkey, or the lira, has been a very, very good carry trade last year. It was one of the best performing currencies in EM. The good thing is also the lira is very idiosyncratic right now. It's not driven by external factors. As just to give you an example, the rand, for example, despite a positive development in South Africa over the last 6 to 12 months, came under pressure at the start of the year when the US dollar again appreciated quite a bit, and we saw a massive move in the high beta currencies like HUF in Hungary, the forint, or in South Africa with the rand. But the good thing is the lira is very resilient to that. So it's not driven by external factors, but rather domestic factors. And as long as there's a credible gradual easing cycle, we are not worried that we're going to see a massive pressure on the currency. So the carry trade, or outperforming the forwards, we expect this to continue at least over the next 3 to 4, 5 months. But it's not going to be the same kind of outperformance that we have seen relative to forwards compared to 2024. So 2025 will be a bit trickier and will be much more gradual. But in nominal terms, the currency has to move higher over the course of the year. And also, we shouldn't forget, the currency is not, in real terms, not necessarily cheap anymore. We have seen a massive real appreciation of the currency over the last 12 months. And at these levels, at some point when we come into the tourism season later this year in April, May, I could see the pressure arising a bit that the currency should, in nominal terms, depreciate a bit further. And we see a bit of an acceleration of the weakness in the currency.
What do you expect in terms of year-end currency?
So we still, as I said, we still believe the currency can outperform the forwards. We can rate levels above 40 is reasonable
40.
to assume. So probably a bit backloaded in terms of the weakness towards the second half of the year when rates have come down quite a bit further. Right now, it's just still the carry is very attractive. And whether they have cut already 250 basis points or not, it still allows for a very nice carry trade. And we are also seeing a lot of excitement among clients to to continue or to increase their exposure to local bonds, which are continue to be well supported and have been rallying strongly since the start of the year.
The disinflation process is convincing? Is
So
slowing?
in the near term, it is convincing, it works well, but we shouldn't, it's a long process. It is because Turkey has decided to go the way of a soft landing rather than a hard landing, which is positive, of course, in terms of for the labor market. We're not seeing a massive shock to it, but then a soft landing requires that the rebalancing takes longer, and it takes longer for inflation to come down. And there are risks to it, of course. If we gonna see a massive increase in energy prices, if there is no, the fiscal is a risk. Fiscal has been very supportive. The credit impulse continues to be positive, and that, of course, has an impact on the disinflation process. And we are at this point in time still very convinced the disinflation is on track. But if the fiscal situation we don't see any fiscal tightening in the second half of the year, then it will be very difficult to really get inflation in towards 15% or 10%. This is still quite challenging to achieve. And the market is also not there yet in terms of believing we can see single digits inflation at any time soon. And I always highlight the inflation expectation surveys 2 years out, which are now have started to increase which came down a lot to 18%. They have increased to 18.6%. So they are on the move, grinding higher, still low and still well below current inflation figures. But they also show us that the market is not yet convinced, or the forecasters are not yet convinced, we can see inflation really moving towards 10%.
Okay, so the expectations are really important in Turkey
Yes.
in terms of managing the disinflation process. I don't know whether you have anything to add.
Yeah, so that's always, this is the biggest challenge that people always underestimate. The inflation expectation have an impact on price finding. And in a country like Turkey, what we have seen is, also from my own experience, spending time in Turkey and Istanbul a lot, you see a very big divergence on, for specific items that you can buy in different places. So there could be a massive difference in terms of the price for a coffee, for example, or pizza. So it's a complete, and this is the challenge, and this makes it difficult. This will be reduced the closer we get inflation back down towards an appropriate level. But it is very important that the officials, and particularly the government and also the central bank, continue on this very credible path, and this that they understand as well that it's not just about success story to get inflation back below 30%, but we need to make a lot more efforts to get to the next step, to have towards, in the next 2-3 years, towards 10%.
Do you expect a rally in the bond market for
Yes,
Turkey?
I think this year is the year of the local bond trade. 2023 was credit. This worked very well, and was a very strong, that strong rally. Last year was a carry trade for the currency, and now, as it progresses, it's usually the third step is always then the rates market, and then it would be the equity market coming after, where we could see significant outperformance when growth has rebounded, rates have come down, and then basically you're going to see the equity market performing. So if someone is constructed as we are on Turkey on the fixed income market, it is the trade is definitely in the bonds, and we are targeting particularly on the 5-year bonds a significant rally over the next 6 months. And I wouldn't be surprised to see levels below 25% in bonds, where we are now trading still at 32 and 32.5. And I think the key point to make here is it's quite remarkable, considering that there's a wide range of forecasts right now for U.S. Treasuries. Some people say they can go above 5%.
Yeah.
Some others say, they're too high, we need to rally. But even I don't care at all what happens to U.S. rates with regards to my view on Turkey, because it's very idiosyncratic. It's about disinflation. It's certain about oil price, definitely. But if they continue with the current, the policymakers with the current path, the bond trade is very attractive for the next 6 months.
So you say that Turkey is more resilient than for external shocks?
Absolutely. And I think that's the key message at this point in time. So if the forecast is of someone like for saying the US dollar is going to weaken a lot over the next 6 months, and the US Treasuries, let's say, will go from 475 to 375, then probably Turkey wouldn't be my first pick in terms of buying bonds. South Africa would look more attractive. But it's the point is that Turkey is very resilient against whatever happened outside. So I'm very comfortable in whatever scenario that from a risk reward perspective, Turkey has a lot of potential to continue to rally, in particular the local bonds. And one point to add, we are also should see further upgrades this year.
I was just going to ask, rating upgrades.
Yes, so exactly. Moody's is coming out by the end of, I think, 24th of January. So we expect them to upgrade. They are still one notch below Fitch and S&P. Maybe they already put them on positive outlook, or like that would even be another positive. But even if it doesn't happen at this review, we believe then later on this year, as the rebalancing continues and the FX reserves continue to increase, I'm very confident that more upgrades could follow over the course of the year.
So any anxiety about January 20th with Trump for the markets?
Yeah, so I think they, although Turkey is, we talk a lot about Turkey and this is a very good trade. I think the focus right now is shifting to the global stage, and all eyes are on next Monday and on how Trump, what Trump will do in his first week, and tariffs.
Lots of uncertainty.
So they are like a lot of, yes, exactly. So the market, no one really knows what's going to happen, whether he goes very hard and is going to announce something immediately and very aggressively, or he goes step by step. So I think there's a lot of uncertainty and on his strategy, and this is basically the argument that there's a lot of wait and see right now, and we need to just react to something that we can't kind of, we have no control and we have no insight into.
Let's wait and see then. Thank you so much.
Thank you very much for having
Wietoska. Christian Wietoska ile birlikteydik. Deutsche Bank'ın Doğu Avrupa, Orta Doğu ve Afrika Araştırma Direktörü. Londra stüdyomuzda buluştuk. Sözü İstanbul'a bırakalım.